Hi students, I am Mahalakshmi, working as Assistant Professor of Commerce Computer Application in V.V. Perumal College for Women, Virudhunagar. In this video, we are going to see about the introduction about basic accounting principles. So for that, we are going to see about what is accounting, what are the steps involved in accounting, branches of accounting and accounting principles. First, we are going to see what is accounting. According to the American Institute of Certified Public Accountants, that is AICPA, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transaction and events which are of financial character and interpreting the results thereof. That is, accounting means art of recording. First, we have going to record and then classify. So, under accounting, we are having a lot of accounts. First, we have to classify what is it, under which account it comes under. These are all we want to know. And then summarizing, and all the transactions must include the money and the events, that is financial character. After that, we have going to interpret the results. Attribute and steps of accounting. First one, recording. So these are all the definitions what we see in the previous slide. First one is recording, then classification, then summarizing, next significant manner, then in terms of money, financial character, and interpreting the results. Next, branches of accounting. There are three branches in accounting. First one is financial accounting, then cost accounting, and then management accounting. Then next we are going to see about the accounting concepts and then conventions. So these are all the principles we have to follow in accounting. First, we have to classify the accounting concepts, reveals their relative importance and their practical use in the accounting processes. So the various accounting concepts and conventions are explained. First, we are going to see the accounting concepts. Later, we are going to see accounting conventions. So first, we are going to see the accounting concepts. Under accounting concepts, we have a 7 concepts. First one, business entity concept. Then second one, money measurement concept. Then third one, going concern concept. We are going to see this one by one elaborately in the next slides. First, we are going to see the title only. And then fourth one is cost concern concept. Fifth one, dual aspect concept. And sixth one, realization concept. And last one is accrual concept. Now we are going to see this one by one elaborately. First concept is business entity concept. Accounts treat a business as distinct from the person who own it. That is, when entering the account, we can treat the person, that is the sole proprietorship, partnership, and the person involved in doing the business is separate from the business. So the business entity is distinct from the owner. Okay, the business entity concept implies that accounting has to maintain financial records of the business, record incomes and expenses of the business, ascertain profit or loss made by the business entity, and show its financial position periodically. The owners of business entity have to be treated like financiers but eligible for profits and responsible for losses. So here we are going to separate the owner and then business individually. So all the transactions involved in the business are recorded as per the accounting rules. The proprietor, that is the owner, is treated as the financier, but he is eligible to receive all the possible profits, and then they are also responsible for sharing the losses. The next concept is money measurement concept. All business transactions are measured, expressed and recorded in terms of money. Here we are going to see mention all the transactions and based on the money only, that is cash, money. Okay, the money measurement concept excludes all business transaction and events which cannot be measured in terms of money. That is business money measurement concept, that is exclude which are all the transactions that cannot measured in money, that can be excluded from the money measurement concept. Thus, the quality of products, value of skilled labor force, working conditions, production policies, etc. cannot be recorded in accounts in spite of their importance to the business. So, these are all the measured terms apart from the money. Quality of product is not considered as the money. Value of skilled labor force, like that, we are not mentioned in the accounting concept. Then next concept is going concern concept. This concept assumes that a business entity has continuity of life. It will continue for an indefinite period of time. Here, the business is run for a long period without any duration limit, time limit. So, run for a so many period. Going concern concept is a basis for several business transactions. Outsiders enter into contract and dealing with the firm. Financial institution lend money to a business unit. So, outsider means the suppliers, then the buyers. So, these are all come under outsiders. They are enter into the contract and dealing with the firm. Financial institution means the lending money. So, they are giving money to the business. Then creditors. So, creditors who supply goods on credit and customer buy goods on credit. So, all such transactions are based on the treatment of business unit as a going concern. Similarly, prepaid expenses and accrued incomes are treated as assets on the presumptions of continuation of business. Prepaid expense means we are paying the money previously for the due date. So, we can pay the money before the due date is called prepaid expenses. Accrued income means we are not receiving the income till the due date. So, we want to receive we have an income but we not received, that is called accrued income. So, next one, cost concept. Transactions are entered in the books of account at the amounts actually involved. So, a firm purchase a piece of land for rupees 1,50,000, but consider it's worth rupees 3 lakh. So, market value is 3 lakh, but we have to originally purchase the land at, for a price 1,50,000. So, here we have to enter only the 1,50,000 as a value of plant, not anymore. Then dual aspect concept. Every business transactions recorded in the books of accounts of a business has two aspects, receiving benefit and giving of benefit. Both aspects of each transaction must be recorded in the appropriate account of a business. For example, when a building is acquired by a firm, that is purchased by a firm, there is a receiving concept. Okay, here we are going to enter a journal entry. Building account data to cash account. So, building we are going to receive, that is receiving benefit. For that we have to pay money, is called giving of benefit. So, building account data to cash account, journal for building purchase. So, to cash is for we have to pay cash. So, that is called cash purchase. And create an obligation for payment in future. So, that is called credit purchase. So, here benefit to be given. Later on, we have to pay money for that amount of building. That is called credit purchase. Next, dual aspect concept is also the basis for accounting equation. Assets is equal to equities. So, assets, what are all the assets the business have? It's called come under assets. Equities means equity is equal to owner's equity. That is capital plus profit and then other liabilities included in the equities. So, assets is equal to equities is the accounting equation, dual aspect concept. So, assets represent all properties acquired by a business for generating income in the short run. That is called current assets. So, assets, we have two types of assets, current assets and then fixed assets. Those assets which are having generating income for the business, that is called current assets. If the assets are giving benefit to the business for a long period, that is called fixed assets. Then the equities are usually subdivided into capital and liabilities, and it distinguishes between the claim of owners from the outsiders. So, the equation is capital plus liabilities is equal to assets, or capital is equal to assets minus liabilities. So here the equity divided into capital and liabilities. So basic dual aspect concept is assets is equal to equities. Equities further divided into capital plus liability. So if you want to know the capital of the firm, we have to deduct liabilities from the assets. Then realization concept. According to the realization concept, revenue is considered as earned on the due date when it is realized. So here we can enter the money when it is actually realized. So the realization concept is vital for determining income pertaining to an account period. It avoids the possibility of inflating income and profits. Here we have to mention only the value actually we had received from the customer or user. Then last one, accrual concept. Accrual concept is the basis for mercantile system of accounting. Accounts maintained on case basis ignore the accrual aspect and use paying and receiving of cash as the criteria for recording expenses and incomes. So while finalizing accounts, all expenses, losses pertaining to the accounting period must be listed out. So the accrual concept ensures that the profit or loss shown on the basis of full facts relating to all the expenses and incomes. So what are all the expenses we have actually made, what are all the incomes we are actually received, that are all only involved in the accrual concept. Next we are going to see the accounting conventions. So first convention is convention of consistency, convention of disclosure. Then last convention is convention of conservatism. So first we are going to see about what is consistency. So the accounting practices should remain the same from one year to another. For instance, it should not be proper to value stock in trade according to one method 1 year and according to another method next year. So if you consistency means we have to follow the same method of calculating the values that can be followed for each and every year till the end of the account. If there is any change, we have to needed, and the change and its effect should be stated clearly. The next convention is convention of disclosure. Apart from legal requirements, good accounting practice also demands that all significant information should be disclosed. Not only various assets, for example, have to be stated, but also the mode of valuation should be disclosed. Various types of revenues and expenses must also be disclosed. Then conservatism. So here the financial statements are usually drawn upon rather a conservative basis. Window dressing, that is showing a position better than what it is not permitted. So the situation or the position of the firm that have been entered in the financial statement as it is. We never mention any extra or any decreasing values in the books of accounts. That is, the secret reserves are not permitted. Thank you. I hope through this video you can have an idea about accounting principles. Thank you so much.